Welcome to the monthly 3-Edge View from the Edge for April 2024. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. Today, as we do at the beginning of each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge research model. As we look back on the first quarter of 2024, we can certainly say that the performance of the global equity markets was decidedly positive. Not only did the S&P increase by over 10%, but also both European and Japanese equities basically kept pace with the performance of the S&P during the first 3 months of the year. And now, as we begin the second quarter, all eyes are once again focused on the Federal Reserve as investors seek to understand when the Fed may start to lower short-term interest rates. Now, recent data show the U.S. economy and labor market remain strong, and inflation remains stuck above the Fed's 2% target, at least for now. In addition, a 20% increase in oil prices this year has not helped the Fed's efforts to tame inflation. And in the final days of last month and the early days here in April, we have seen bond yields rise. The 10-year yield of the U.S. Treasury reached its highest level of the year so far, though it's still well below its peak of 5% in the fourth quarter of last year. And the backup in yields may have prompted Fed Chair Powell's recent comments, where he insisted that the Fed still plans to lower short-term interest rates sometime in 2024. However, the longer the Fed waits to begin to cut rates, the higher the probability of a recession later in the year. And importantly, all else being equal, lowering rates too close to a presidential election is something that the Fed presumably would like to avoid. So let me bring Eric into the conversation to provide our outlook for the markets, which again, based on our proprietary model, and let's review our 3-Edge asset class matrix, which shows our current outlook and what may have changed over the course of the month. So Eric, take it away.
Awesome. Thanks, Fritz. Yeah, what are we looking at here? We're seeing the U.S. remaining with a positive outlook, Europe moving up to that mixed, joining Japan, which stays there, China EM staying in that negative spot, and India mixed to maybe slightly positive, but we're showing it mixed here. Rates moving down to the mixed camp, while credit remains with that negative outlook. From our perspective, cash still attractive at the short end, earning a nice yield. Gold moving up one spot, as well as commodities moving up a spot as well. So good things happening, good things to discuss.
Excellent. So let's dig in. Let's look at the major asset classes, and we can begin with equities. And why don't we begin looking at the U.S. equity markets, which pulled back here recently as bond yields rose. And I suppose since this is such an investor psychology-driven market, we need to see if the S&P can break above, right, that recent high in March. But what is the model telling us about U.S. equities?
Absolutely. After being up just over 10% in the first quarter, it's a very strong quarter. Our model research is showing the potential for a pullback of a profit-taking type correction in the near term. To be clear, we aren't calling for that as a base case, just that the heightened risk exists. And so as such, we have lightened up somewhat on U.S. equities in our core solutions. But again, it isn't clear that the run is over just yet, as you talked about. With earnings season upon us, we'll likely continue to mold that outlook in the weeks ahead. So no doubt we'll also be keeping an eye out for potential shifts in the outlook for monetary policy as well. Consensus seems to be that there'll now be 3 cuts this year, potentially starting in June. But time and incoming data on jobs and inflation will be telling, obviously. So overall, the outlook remains positive here.
Absolutely. All right. So let's look at the equity markets outside of the U.S., beginning with European equities, which, similar to the situation here in the U.S., investors are focused on the ECB and monetary policy. What's the model telling us?
Yeah, European economies continue to face many challenges. European equity markets, that said, rose in the first quarter on par with U.S. equities, supported by positive investor psychology and declining inflation in the region. I think at this point, all eyes are on the European Central Bank, the ECB, which, thanks to that declining inflation, could be in a position to begin cutting rates in the coming months. Current shape of the yield curve, as we calculated, indicates a potential for a slowdown, But these rate cuts at the short end may help the yield curve move in that steepening direction, which might provide a boost to the outlook, our outlook, I should suggest, in the near term. So the outlook is upgraded to mixed, and the potential for a further positive move too.
And maybe the ECB will even go before the Fed. Who knows?
Very possible. Yeah.
Excellent. So let's shift our attention to Asia, Japanese equity market, which was quite a story in the first quarter, right? Because it finally broke above a level that I think it hadn't been at since 1989. But what is the model telling us about the potential direction of the Japanese equity markets?
Yeah, Japanese equities kept pace with the S&P 500 in the first quarter, up around 10% too, like you mentioned. What's interesting is on a hedged basis, nearly double the performance of the S&P 500, with the Japanese yen falling around 7% in the first quarter against the dollar. And that's despite the Bank of Japan finally putting an end to its negative interest rate policy by bringing yields at the short end positive. The decline in the yen is likely the result of stronger than expected growth of the U.S. economy, which has meant that the Fed hasn't been able to begin lowering interest rates just yet. Now, investors are watching to see if the Bank of Japan may need to hike interest rates further to defend the yen's value. So we'll obviously be keeping an eye on that. Monetary policy here in the U.S. and there in Japan are likely to just significantly influence Japanese equities in the coming months. So outlook remains mixed, and we'll be watching monetary policy very tightly, very closely.
Interesting, the connection between the value of the currency and, basically how much profit you earned investing in Japan, whether you were long the currency or you were hedged against the currency. It shows how important those currencies can be.
Absolutely.
So let's shift to the emerging markets and China and see what our model research is telling us there.
Yeah. As is the case in Japan, you have this strong U.S. labor market, strong GDP growth, make it appear that the Fed may need to leave short-term interest rates higher for longer and reduce the number of rate cuts in 2024. This scenario is supportive of the U.S. dollar, and that could be a headwind for China and other emerging markets in the short term. Although the Chinese government has now taken more steps we've seen to support the economy and the stock market through these stimulus programs and market interventions, it still just remains uncertain whether these efforts will be enough to, convince investors to really get reinvested in the Chinese equity market. So I think the bias is towards broader EM exposure, if at all, with the outlook remaining somewhat negative.
Okay. So our last equity asset class to discuss is India. And what is the research indicating there?
Yeah, similar to many of the global equity markets, India's equity market is benefiting from positive investor psychology, market momentum that we've seen so far in 2024. India's equity market remains overvalued by our measure, but some exposure to Indian equities could make sense given that the longer-term growth prospects are very favorable for the region. Also, the Reserve Bank of India, which is India's central bank, they may be inclined to lower short-term interest rates in the near term as inflation measures are back inside their target range, which is a much bigger, broader range than say here in the U.S. But that could provide a boost to the near-term outlook as well. So we'll be keeping an eye on that.
All right, a lot going on in equities. Let's shift now to the bond market and the current interest rate environment, starting with the U.S. Treasury market, where, as I said, rates have backed up recently here. And I guess I sound like a broken record, but bond market investors also looking at the Fed to see what monetary policy, the direction of monetary policy going forward. But what is the model expressing in terms of the Treasury market for interest rates?
Yeah, U.S. Treasuries have definitely struggled so far in 2024, certainly relative to equities. Shorter-term bills have performed as expected, but U.S. Treasuries with intermediate and longer-term maturities declined in the first quarter. Strength of the U.S. economy and the labor market, along with inflation readings above the Fed's preferred 2% target, have investors concerned about when the Fed may begin to lower those rates that we keep talking about. Market pricing is showing, we believe that the market believes that the Fed may start lowering rates at the FOMC meeting in June. Additional cuts priced in for September and December. Of course, time will tell. The recent backup in yields we've witnessed that you talked about here in April now, we've witnessed may have prompted the recent comments from the Fed chair, who insisted the Fed is still planning on lowering rates in 2024. So there's a lot of moving parts here. Given the risks that inflation may persist along with an increasing supply of government debt issuance, shorter maturities just continue to provide the attractive yield, remain more attractive position on the yield curve, in our opinion. for the time being.
Absolutely. There's no reason to go out the yield curve at this point.
That's right.
So let's shift gears, look at the corporate bond market, or what's referred to as the credit markets. And what is our model indicating there?
Yeah, the risks of an economic slowdown, the tightening, and more importantly, the tightness we've seen in corporate credit spreads, which just remain at absolute, very tight levels. The risk to the downside for little potential upside benefit over Treasuries just doesn't seem warranted to us at this point.
All right, excellent. So now we will shift gears and look at the asset classes that are referred to as hard assets or real assets. And that would include both gold and commodities. And so why don't we begin with taking a look at what the model's indicating for gold?
Yep. Price of gold has generally kept pace with the performance of U.S. equities year to date, up over 7% in the first quarter, hitting an all-time high at the end of the quarter, and then actually continuing to move even higher here in April. Gold has benefited from positive investor psychology measures, momentum, an increase in central bank purchases, rising geopolitical tensions, and short covering we've seen. And, the kicker, the prospect of a decline in real interest rates, that is inflation-adjusted rates, would only likely further support continued gains for gold. So the outlook's definitely positive here and possibly moving even more positive.
All right, excellent. So now let's take a look at the commodities market. I did notice the price of cocoa increased dramatically in the first quarter, which means we have to pay more for chocolate. Anyway, I digress. But I did mention at the outset that the price of crude oil has definitely risen since the beginning of the year. So what is the model indicating in terms of broad commodities?
Yeah, that's right. Yeah, we're seeing a number of commodities move higher, some for idiosyncratic supply issues and also for the heightened geopolitical tensions we've seen. All that said, our model research, it's still negative as investor sentiment in China is weighing on the commodities complex, broadly speaking. But should the value of the dollar decline from here, then, just broadly speaking, dollar-denominated assets like commodities could benefit. So more mixed outlook now, possibly moving more positive in the near term.
All right. Excellent. All right, Eric, thank you very much providing our three-edge view from the edge for April 2024. If you'd like a hard copy of the full View from the Edge newsletter for this month, you'll find that on our website at 3edgeam.com. Of course, Eric and I will be back early in May with another edition of the monthly 3-Edge View from the Edge. And meanwhile, Steve Cucchiaro and I will return next week with the latest edition of our 3-Edge Week in Review. As a reminder, our entire library of video content is always available on our 3-Edge YouTube channel. You can just go over to YouTube, search under 3-Edge. And if you think that someone you know might benefit from our videos, please feel free to share them. And so that will do it for us. On behalf of Eric and everyone here at 3-Edge, thanks for listening.